The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An unsurprising U.S. inflation report unlocking a surprising rally in U.S. equities. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. My number for you is 44. What the NASDAQ 100 could see for a record high this year. Yeah, we're moving on here. It looks like we're going to get there. NASDAQ 100 at a record high of a whopping 2%. The S&P a little bit far off. We may not get there for another record high, but up 0.8%. But it's really led by big tech, Romaine. Mag 7 all at a record here. You got Tesla, Google, Amazon, Apple, all at record highs.
Yeah, those are the big heavyweights here after coming off of 2 days of declines for both the S&P and the NASDAQ. That's all in the rear viewer now. One of the last major economic reports of the year did drop, and it gave traders relief with an inline core inflation reading that should clear the way for a rate cut next week, even though progress towards the Fed's 2% target may have even slowed or stalled.
Barring some shock, the CPI numbers will trend down next year. And, the next few months are going to show some high year-over-year numbers. But by next spring, I think we're going to be below 2% in year-over-year CPI.
And honestly, that's really just good enough for equity markets. As you see in the price action today, the S&P barreling towards a 58th record high, the NASDAQ 100 towards a 44th, lifted not by inflation-sensitive cyclicals, but like Alex said, big tech. Meta on a 2-day run to an all-time high. Apple on a 3-day surge to a record. Alphabet up a 4th day to what would be its first record close since July. And how about Tesla? Extending its rally a 6th day here as it looks to notch its first record high, and I couldn't believe this, since 2021. Animal spirits definitely back in public markets, and maybe they're actually back in private markets too. President-elect Trump's pick of Andrew Ferguson to replace Lena Khan at the FTC, that could clear a big path for bankers searching for deals. Heck, PJT Partner CEO Paul Taubman just this morning telling Bloomberg he's on an aggressive hiring spree right now as 2025, in his eyes, Alex, could be the second best year for M&A in at least a decade.
Truth or wishful thinking or somewhere in between? We will break it down throughout the next hour. So this is one of my true and tried favorite charts. It is rate cut expectations from the Fed for December and as well as January. And for December and January, you can see kind of where we were just back in September. And this is where we are now. So cumulatively, we're looking for just 28 basis points of cuts in the December and January meetings. So reading between the dots, it looks like a December cut, TBD when it comes to January. Now, overall, if you look at WIRP, WIRP, go on the terminal, it looks about 110 basis points from now until the end of December of 2025. That really means just about 3 cuts next year if you take into account December. And Romaine, has the market really re-rated for that? And does the inflation data back that up?
Well, let's talk a little bit more about that inflation data as we kick you off to the close here on this Wednesday afternoon. We did see U.S. consumer prices in that official monthly report from the government rising 0.3% in November, a rate that was in line with expectations. The data may be solidifying expectations about that Fed rate cut. Stuart Paul joining us right now from Bloomberg Economics. And so when I looked at all the numbers, whether it was month over month, year over year, core, super core, everything was relatively in line with estimates here. So what are we celebrating today?
There are a few things that are worth celebrating. The first is that the long-awaited decline in owners' equivalents of rents and a headline primary rents. We're starting to see a little bit of a slowdown there in those key shelter inflation components. When we also look under the hood, one of the major driving forces behind core inflation was used auto prices. But if you disentangle what's actually happening on auto lots versus what's going on with seasonal adjustment factors, it's really just seasonal adjustment factors that were boosting those prices. Then if you really drill down within the headline, about 10 basis points came from food, gasoline, and very volatile hotels. So it gives a lot that the Fed can read through, and it's starting to see some of the indicators that it looks for, that restrictive monetary policy has taken root. It can ease off quite a bit, and it keeps that December cut in play.
So no reason to think, though, that this could be one of those one-off monthly head fakes, if you will.
I don't think so. I think that there are a few things that are going to be persistent. One is disinflation in shelter. That's going to be something that's going to have long legs. It's going to be a bit slower than we expected if we roll back the clock about a year ago. But we are going to see some legs to that shelter disinflation story. Unfortunately, unfavorable base effects and some of those seasonal factors are going to keep propping up annual measures for just a few months more.
For services backing out housing, Are we going to see more disinflationary effect going forward, or is that topped out?
We can see some more disinflation going on there. We do think that the labor market is cooling. We do think that wage growth is going to continue cooling. That should remove some of the underlying inflation pressures coming in those key super core services categories.
Well, I was telling earlier about WIRP and looking at 110 basis points of cuts from now through December of 2025, which would imply December and then maybe 3 rate cuts for 2025. Does that meld with what you guys are looking at over at Bloomberg Economics?
We think that might be a little bit much. We think that we're going to get that December cut. We do think that we'll probably get at least 2 more in 2025. But then it's going to be really difficult, and it's going to depend on the trajectory we think of inflation. If the Fed is able to get some traction in slowing the pace of labor market cooling with the cuts that it's already done, then we can see a prolonged pause after maybe just 3 more cuts, including December.
Interesting. All right, Stuart, thanks a lot. Really appreciate it. Stuart Paul of Bloomberg Economics joining us on that. Here for more on the context, what it means for the markets, is Gargi Chaudhuri, Chief Investment and Portfolio Strategist of the Americas over at BlackRock. Hey, Gargi, we're just talking about the Fed cuts. Do you feel like the inflation data that we've gotten out in the growth forecast for next year change your trajectory for rate cuts from the Fed?
Hi, good afternoon. It's so great to be here. Couple of things that I wanted to point out about today. The first one is certainly around the incredible inflation data that we saw today. I think the headlines sort of mask the improvement in inflation, especially when you look at the autos number, which was hopefully a one-time sort of impact. I think what this means really for the Fed is, at least for December, that's a clear signal for a 25 basis point cut. And then it also allows them the luxury to see how the data evolves. And I think the other big thing that we have to think about is, alongside the easing that we're going to get in December, the data has been really good. So the labor market is just at that sweet spot where jobs are growing, but not at too high a pace. We're seeing wages still solid. The consumer feels good, but not too good. Mm-hmm. And now we're going to have this rate cut, but we can still sort of pause at a little higher rate than we perhaps initially thought. So all in all, really good for investors in equities as well as income in the fixed income market.
Okay, so if that's the case, are markets getting it right now, or is there some complacency here?
I think that, at least for the equity markets, I think the markets are certainly getting it right for now. Markets are doing very well. As I said, the backdrop is very positive. We think that some of the large cap areas of the market are the ones that should be performing in this rally, perhaps not so bullish around the small cap specifically. As it comes to the pricing in of how many cuts for 2025, I think, again, there, to your point earlier, WIRP is pricing in a little over 100 basis points of cuts. I think it's still a little too early. I don't think we get quite so many. But look, there's huge amounts of interest in the fixed income markets. There's huge amount of flow. We saw that in the 10-year auction today. We see that in the fixed income ETF flow. So I think that bond markets continue to hold in and equities continue to hold in as well.
What do you see, if anything, Gargi, that actually could break yields out from kind of this narrow range that they've been in, either up or down?
Yeah, so on the yields moving higher, especially as it pertains to the long end of the curve. So here I'm talking about the 30-year, which, has come down below that 4.5% level. I think on the breaking out to the higher side, I think it has to be concerns around the deficit. Obviously, the expectation of a steepening yield curve and higher long-end yields was one of the big expectations coming out of elections. The Trump trade was supposed to be followed by a steepener. That hasn't happened. As I pointed out earlier, we've seen 34 straight months of inflows into fixed income ETFs, and that is demand for fixed income. That's demand for income as well as a little bit of duration. What can break us out? Certainly fears about deficit and increased issuance returning to the market. What can break us down to the other side? What can lead to significantly lower rates? I think is actually concerns around the labor market. So far, it has been, as I mentioned earlier, just the sweet spot of jobs still continuing to grow at about, call it, 173,000. Looking back at over the last 6 months or so, but slowing down from 2023 and 2022. That's great. But if we see the continuation of unemployment rate going up for the wrong reasons, because demand for workers actually takes a dip, I think that could be something that breaks bonds down to the lower side.
Absolutely. And it'll be interesting to see, too, what type of competition we see between stocks and bonds. We're just getting started here in conversation right now with Gargi Chaudhuri, Chief Investment and Portfolio Strategist of the Americas at BlackRock. That conversation continues in a minute. We do need to take a quick break. But when we come back, we're going to get her thoughts here on a record day for big tech. This is The Close on Bloomberg.
We are looking at 44 record highs just this year to the NASDAQ 100. The overall NASDAQ also at a record. Tesla leading the way here with a $515 billion rally over the last 6 weeks. Here with us still is Gargi Chaudhuri, Chief Investment and Portfolio Strategist of the Americas at BlackRock. Gargi, here is my profoundly intelligent question. Do you buy tech at these records, or is this just a weird safety growth play?
I'd say that the way we're talking to clients about this is taking a sector neutral approach. So we are talking about quality, but taking a sector neutral approach to quality. So yes, you absolutely need to have some tech, but I think 2025 is going to be the year that we are going to see that broadening out. We've already begun to see that. We still like financials despite the rally, and I think that's going to continue to happen for 2025 as well. So that's number one. Number two, I think that look, some of the larger names, we just launched Top T, which is the top 20 names in the S&P 500, and that's seen a tremendous amount of interest. I think some of those larger names, which are the most cash flow rich and the strongest earnings, probably continue to do well. So I think this is the time for investors to sort of build that quality portfolio with companies that are cash flow rich and low levered, as well as sort of tie in some of the breadth. Financials is an area of the market that we really like, and we think that can continue to do. So both of those, I think, in your portfolio make a little bit of sense.
How does that then pair if a stocks versus bond conversation? Vanguard said that they're taking more of a defensive stance, right? They're like 62% fixed income versus 38% stocks. How would you see that allocated?
Certainly. So again, in my role, what we tend to do is look at a lot of portfolios. And what we're finding in advisor portfolios is that exactly what you talked about, this allocation, especially to U.S. equities, even away from other corners of DM and EM, but an increasing allocation to U.S. equities. We think that makes sense, especially over the next 12 months or so, with that U.S. exceptionalism trade just beginning to play out. So absolutely having a more of a favor or more of a focus on U.S. equities specifically, staying focused on quality. And then within bonds, look, there's still a role of bonds in your portfolio. You can build a 6.5% to 7% yielding portfolio without taking too much duration risk. And that's exactly what investors are supposed to do. So stay in sort of that 3 to 7 year part of the curve, stay in the belly, clip your coupon, earn some income, go into things like CLOA, go into things like a high yield with HYDB, go into things like bank and clip that coupon.
And that's certainly already paid dividends, pun intended, over the last year or so, and maybe that continues in 2025. I am curious, though, about the tech side of the equity trade, at least, and the idea that we're also going to be facing some really astonishing comparisons next year, particularly for some of these companies that have had a record year, not just in terms of their stock prices, but also in terms of what we saw out of their income statements. How is that going to affect the psychology around some of these names, like the Alphabets and Teslas and Amazons and Apples of the world?
So I think what you're referring to, if I'm understanding correctly, is sort of the year-over-year growth and the sharp deceleration in terms of where you were in 24 and perhaps even 23 versus 25 in terms of earnings growth. And yes, there is going to be a little bit of a closing of the gap between the Mag 7 and the rest. But it is still those quality companies that are going to continue to generate earnings growth, right? Alongside that, what I'm excited about for 2025 is the rise of the rest. And this is why we've been talking about other areas of the market. We certainly talked about large cap value as one of the ways in which we can play this. Financials continues to be a great area of the market for earnings growth. So I think sector neutral quality continues to work in a portfolio where, yes, the earnings growth could slow down, but it still remains very, very high. If you look at 2025 earnings expectations growth for now at 13%, A big chunk of that is still coming from tech and comm services. And I think investors are going to continue to pay attention to that. I think first quarter earnings, what we'll focus on is if that margin expansion has continued to remain steady.
This is kind of a nice mapping out of maybe how people are going to sort of look at their portfolios into next year. I don't think we've talked too much at all about true alternative investments. And I mean, you guys are kind of the OG in that space. And I am curious as to what does that allocation look like in 2025, particularly given how much we've said these outsized gains in equities and in some of the more traditional investment vehicles?
Such a good question. And I think the three things that we're thinking about and talking to clients about right now is, number one, if long duration doesn't play the same role in your portfolio as it did previously, what then should be your portfolio hedge? Obviously, we talked a little bit earlier about income in the front end of the curve, the belly of the curve, and that can continue to be a driver of income and perhaps even a hedge. But why not consider things like gold, right? Obviously, an incredible year for gold this year. The second thing that we're talking to investors about is finding other sort of what we call liquid alternatives, finding sector neutral and market neutral approaches to diversifying your portfolio without taking a lot of beta risk, without taking a lot of market risk in one direction or the other. And then the other thing that comes up a lot is really finding hedges for your inflation risk. So yesterday's number was very friendly, as we talked about, but there is some concern around inflation risks in 2025. So thinking about adding inflation hedges with either perhaps, again, like we talked about gold, also other things that come into mind are inflation-linked bonds. And another thing that comes into mind is looking at aerospace and defense, which have historically had a very high correlation to trade uncertainty.
Gargi, always a wonderful conversation. Always appreciate you taking time for us. Gargi Chaudhuri there, Chief Investment and Portfolio Strategist of the Americas at BlackRock, kicking us off to the close here on this Wednesday afternoon as we keep a close eye on some of the individual movers not partaking in today's rally, and that includes Macy's. Of course, a delayed earnings report, accounting investigation, and now activist investors once again circling the wagons. A conversation up ahead here about how the company navigates through the challenges. This is The Close on Bloomberg. All right, let's get a view from the sell side. It's our top calls, the big movers on the back of analyst recommendations. And we start off today with Netflix. JP Morgan raising its price target to over $1,000 a share from $850 and keeping an overweight recommendation. The analyst, he's touting the streaming service's strong original and licensed content, healthy daily active user trends, and better contributions from that new ad tier. Shares up to a record high, up about 3%. Next up, Duolingo. Bank of America downgrading to neutral, with the analyst led by Curtis Nagel saying the company may be one of the highest quality and most consistent growth names within the internet space. But much of that growth is already priced in. He's also cautious that Duolingo's near-term estimate revisions may be lower than in previous quarters. Those shares taking a leg down by about 6%. And let's end things on the home builders. Barclays cutting its ratings on D.R. Horton, Lennar, and KB Home to equal weight after 2 years of bullishness. The analyst citing swelling valuations and says the new construction market has likely hit a ceiling. He also sees rising labor and land costs posing a risk to gross margins. Those shares down 3.6%. And those are some of our top calls. Let's take a look at another mover also to the downside, and that is Macy's. The department store company releasing quarterly results this morning, cutting its profit outlook after an employee intentionally hid tens of millions of dollars in delivery expenses. Joining us right now to talk a little bit more about what we learned from this quarter and what we could learn in the quarters ahead is David Swartz, Senior Equity Analyst at Morningstar Research Services. He has a buy rating on the shares. Let's start off, of course, with that accounting investigation. According to people familiar with the investigation who spoke to Bloomberg earlier today, they said, look, this was an individual mistake. It was for small parcel delivery expenses. The investigation has covered all it needs to, and this is now behind it. A small restatement, and now the company moving forward. David, are you buying it?
Yeah, I think so. We haven't heard anything different. As it is, it's immaterial. It's $150 million over 3 years. That's a small amount of money for Macy's. So if that turns out to be just the sum of the misstatement, then it isn't really significant. It is a little bit embarrassing, certainly for management, that something like this could go undetected for so long. It's also a bit perplexing as to why a Macy's employee would do this, because Macy's says that the person had no criminal intent. So it doesn't really look good, certainly, but as far as valuation goes and as far as Macy's as an investment goes, I don't think it's significant at all.
And the company is saying that it is still reviewing a lot of how it enters things manually as well as accruals, and we'll have an additional update here on how it's going to improve its accounting controls. David, I do want to talk about the actual performance of its main business, of course, and that's selling items here. You saw the forecast on the sales side, bumping it up just a little bit, obviously a little bit of a pullback on the profit forecast. Were you happy with what you saw in those numbers?
I wasn't really surprised. I would say that it was a bit of a disappointment that Macy's brought down its EPS estimates again for this year. It hasn't been a great year for Macy's, but realistically, Macy's has been struggling for a long time, and it's really just the first year in a turnaround plan. And so we have to expect that it's not going to be a straight line up. There are going to be some problems along the way. And it does look like the fourth quarter sales are shaping up to be pretty good. But it looks like it's going to come from promotions and a lot of discounting, and so that's going to hurt margins.
What about the new stores or the updating of stores that they're doing? Is that successful? Do we feel good about how that track record will be?
So far, so good. Yes, the first 50 stores, as Macy's calls them, are the stores in which it has implemented new merchandise and new selling techniques and increased staffing in those stores. And those stores have posted better same-store sales numbers than the rest of Macy's. However, it's still early, and we don't really know if that will translate into better sales for the other stores that this rolled out across the fleet, because naturally Macy's chose the best 50 stores to start this plan. And so we don't know if it's going to work as well in other stores that are less performing overall. So it's still early, but it does look like something that is working, at least for now.
All right, David, thanks a lot. Really appreciate David Swartz joining us over at Morningstar. Appreciate that. It sounds a little bit, though, when they update their stores, it's like a little bit of Bloomingdale's light in terms of the new designers that are coming in terms of the cosmetic center, the Blue Mercury.
Yeah, and I mean, that shouldn't be a surprise given who the CEO is. Of course, Tony Spring made his name running Bloomingdale's and actually kind of turning Bloomingdale's around. And I guess he's trying to work some of the same magic with Macy's. I do want to see what 2025 holds in store, because when you look at that forecast, it was a little concerning. And you do wonder, given the distractions, or not only with this investigation, but we didn't even get to ask David about all the activist investors that are still kind of circling this company, how they could sort of navigate that. And
that's not even talking about the macro environment. This is all just company specific too. And then what happens with, say, tariffs, what happens with consumer spending, what happens with wages, all of that coming in as well. So lots more questions that we have. All right, coming up. It's the week of M&A, and it keeps getting weirder and weirder. Let's just put it that way. We'll break that down with Ethan Klingsberg, partner and co-head of U.S. Corporate at Freshfields. This is The Close on Bloomberg.
I think we're on the verge of a really big uptick in M&A. We are in, a multi-year cycle of extended M&A activity. If you go back in 22, 23, and even 2024, that's not the steady state environment for activity. And that's why we were so aggressive in hiring these last 2.5 years. You can't hire today. You need to have planned for this, and we've been planning for this.
Yeah, don't let the stoic look on his face fool you. He is excited, as a lot of people are excited here, about the potential for M&A activity. Romaine Bostick here with Alex Steele, 3:30 p.m. here in New York, and we are counting it down to the closing bells.
Right, obviously talking his book, so he's really looking forward to it. But we really need it. If you take a look at M&A, Bloomberg Intelligence had a great chart out that looked about the amount of deals we've seen so far this quarter. It's only been $94 billion. That's down 62% versus the recent peak that we saw, and premium, lowest in a decade.
Yeah, it also feels like, too, this is kind of like that snapback, like when you're sort of starved for so many months or maybe a couple of years now, and you finally sort of get, that morsel of food. It's like the best thing you can ever eat, right?
Right, yes.
Does that analogy work for you?
Yeah. Or pistachio martini. It could also be.
Okay, we're going to talk about
the
pistachio martini
we
a little
have
bit
different
later,
issues with that.
I've got thoughts.
Yeah, okay, so we wanted to get a different take on this. Joining us now is Ethan Klingsberg, partner and co-head of U.S. Corporate and M&A over at Freshfields. Okay, so that's the bullish case, right? We're going to see lots of M&A. We're not doing well so far this quarter, so we're going to see some nice rebound next year. Do you buy it?
Well, you have to look at the M&A in different buckets, right? One of the things you hear a lot about is how there's thousands of these privately held portfolio companies by private equity that are past their sell-by date, and the funds are dying to sell them. There's a lot going on that's enabling the private equity funds to have liquidity without selling them. So you're having continuation funds, we're having GP secondaries, LP secondaries, they're putting debt on some of the funds. That takes a lot of pressure off the M&A. Also, same with IPOs. In the public markets, by the way, that stuff I think could come back a little bit stronger if interest rates went down significantly.
Okay.
On the public,
what's significant though? Because I mean, we're already
exactly we're not that low. I think we got to go. We got to go back.
Okay.
Remember, these companies were bought when prices were pretty high,
Yeah.
and interest rates were much lower. They were, these are like COVID era.
We're not going to zero.
We're talking
though,
like
again.
1% or
Yeah,
less. And now
so
we're
I don't.
at 4
That's why I'm
3/4.
not very bullish on a lot of those thousands of portfolio companies being sold in the near term. On the public markets, we'll continue to see private equity take private some of the weaker companies with $1 to $5 billion market caps, and maybe we'll see some weak companies that are, in 10 million, 15 billion. Those will be very exciting deals. What we're seeing now, we saw recently Berry sold itself in a stock for stock deal, Interpublic stock for stock. A lot of this comes from dispersion in the markets. When things are going really well, some of the guys who aren't doing as well, you could do stock for stock deals, which are very logical. So I think we may see some more of that. And as far as Paul's remark about hiring, we're beefed up. You gotta, because there's definitely a lot to do.
What about all the dry powder that is said to be out there raring to go? Is that real?
Yeah, well, there's definitely the financing dry powder. There's a lot. There's trillions of dollars in direct lending, and that's been there though for all year, right? So, and they're very competitive with the banks, and most financial advisors are pretty fluid in saying, let's just get the best for our client and bring that in. So I don't think the dry powder is the determinative factor. I think it's going to be prices coming down, or prices going up, for that buyers are able to pay, and also the interest rate environment. But also, if we keep going into this big secondary world, IPOs and public M&A may really not be the wave of the future.
Yeah. Well, I am curious, just when we talk about let's just talk about deal-making activity. It's kind of as an umbrella, broad umbrella here. And a lot of the excitement, of course, is about a new presidential administration here in the U.S. that promises to be more business-friendly. We know potentially who the new FTC chair is going to be. It's not going to be Lina Khan. We know that much. And you got Andrew Ferguson coming in. I would assume that if you want to do a deal, I feel like the next year, 2, 3, 4 years would be the time to do it.
If you look at people also like Ferguson, Gail Slater, who's taking over for Jonathan Cantor at DOJ antitrust, there's such a tension that we're seeing between deregulatory trends and populism trends, right? So Gail Slater was in private practice, actually at my firm. She worked for some Silicon Valley companies like Roku, a client, and then she also was J.D. Vance's primary advisor on these kind of issues. So that J.D. Vance said some very nice things about Lina Khan. Trump, when he announced her, said some pretty nasty things about some tech sector issues and stuff. So I think there's this tension. I think we're going to see more look at economics rather than just some of the fluffy labor issues and just general antipathy toward M&A. I also think we'll see more deals with the regulators. In other words, they're not going to say, we're not going to make a settlement. If you could come up with something rational, I think there's a much better chance.
Because this was one of the big criticisms of the Biden administration. It wasn't just that they were putting up roadblocks, but it was that they weren't necessarily offering solutions either.
Yeah.
And which was kind of the message was, don't even bring us anything at all. Obviously, it's going to be different. If a client calls you and they've got a deal and they're concerned about, okay, is this going to make it through, national security tests, the populism test, which is going to be a real thing over the next 4 years as well. What's the advice that you give them?
Yeah, we got to get the narrative really down on antitrust and foreign investment regulatory. First of all, look, judges, there was just the Krogers, others, judges have normalized among the judiciary this idea of blocking deals, which we didn't see 5 years ago. There were some, but now it's happened enough times that I think there's I don't feel as confident saying this is a really aberrant case. Also now, boards of targets have become, they know this stuff now. They all know all about reverse breakup fees and outside dates, hell or high water covenants. All of a sudden the directors are really, and they've been traumatized by certain events that have happened. A lot of them sit on multiple boards, and so they've seen deals that have been blocked. And so you've got to go in with the story saying, here's how we're going to get, I know that we may have some overlaps, we may have some vertical issues, but here's the compelling narrative that we have. The other point is, if we're going to expand in the Hart-Scott-Rodino filings, because there's maybe new rules coming into effect, it depends what Ferguson does, but there may be much broader set of documents that come in. And so we've got to tell clients to really think about how you describe your enthusiasm for this deal. And is it, are you creating problems for yourselves in describing it as having competitive issues?
Specifically when it comes to big tech, I'm really trying to get a read on if their problems persist when it comes to merging or not.
Right.
Isaac Boltanski had a great note out. He was like, the hipster era of, blocking deals is over, but there's still a lot of headwinds for big tech. But then it seems like sensory is definitely blown wide open. So what do you think? Censorship.
Yeah.
What do you think?
I think, as I said, you've got to do your homework.
Yeah.
I think that every buyer, whether they're big tech or any consumer issues, groceries, consumers, everybody's, whether women's handbags, last time I was on, we talked about all of this stuff. You've really got to get your story down because it's not going to be easy in any of them. And I think what we're going to see is buyers are going to be much more disciplined. So, even though the losing Lena Khan didn't do that well as far as batting average and Jonathan Cantor, the number of deals that just didn't happen because buyers are saying, I got to use my capital wisely. Because it's, you're going out to your shareholders. It looks terrible to announce a big deal on the buy side and not get through. Same on the target side. Yeah, well, no matter what the actual deal count ends up being in 2025, I have a feeling you're going to be really busy. A lot of people are going to be calling, looking for advice on what to do and how to do it, Ethan. You're going to be spending a lot of time in Washington, I have a feeling. Well, we hope that there's a... It's a nice place to visit. I wouldn't want to live there. Ethan, we've got to leave it there. Always a great conversation. Thanks. Ethan Klingsberg, co-head of U.S. Corporate and M&A over at Freshfields. Stick with us. A lot more coming up, including a look at shares of U.S. healthcare companies taking a leg down. This after proposed legislation in Congress that might cause some major changes for pharmacy benefit managers. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. More than 80% of the prescriptions here in the United States that get filled go through three companies, United Health, CVS, and Cigna. All three of those stocks right now are moving lower. This after we learned that a group of lawmakers, a bipartisan group to be sure, have drafted a bill that would force the prescription drug middlemen to sell the actual pharmacies that they own, citing conflicts of interest. Isabel Lee, who covers stocks for us here at Bloomberg, joins us right now to talk about our stocks, plural, of the hour. All right, let's start with this legislation. It's not out yet. It's being drafted by Elizabeth Warren, a Democrat, and Josh Hawley, a Republican. Strange bedfellows, which as politics often makes here. What exactly are they trying to accomplish?
So it's a bipartisan effort, which to your point, it's a unique combination, which shows how maybe popular it can be, but it really just threatens to break up the nation's largest healthcare companies and force them to sell off their retail arms. Because the argument goes, if you're the one that sets a prescription, why are you the one selling it too? So they want to get rid of the middleman, aka pharmacy benefit managers. Let's just call it PBMs, because they're the ones who oversee prescription drug benefits. So it's really a conflict of interest more than anything. And to your point, they control 80%. That's really huge. And as we know with recent events, there's just a lot of angst over that sector.
What's the other side of it? I mean, clearly these guys merged to begin with, so there must have been a reason why. What should the quote-unquote benefits be of having the PBMs and drug retail stores?
I think if it's just companies getting bigger and bigger, it's harder to really break up. I mean, you see that in the tech space also, you see it now. We have Evercore saying that if this passes on next year, which is likely the case because we have the last few weeks of Congress, it will have a higher chances of passing more, but It still remains to be seen. It's just really another renewed effort. This isn't the first bipartisan effort.
Yeah, and to Alex's point too, though, I mean, I was actually covering a lot of these stocks when they sort of became these sort of big conglomerates. That was sort of the saving grace. It was like, buy a PBM, or if you're a PBM, buy a pharmacy. The idea was we were going to create these kind of, retail healthcare superstores, and we know that's kind of backfired. You see it backfired with Walgreens in a big way, and now maybe they're going back private. And CVS, which of course owns the CVS stores, and then of course the PBM CVS Caremark. It's been a struggle.
But the pushback is that they could actually compete with drug makers. They could push back and they could get better discounts, whether or not that actually happened. But that was sort of the thesis.
Yeah. And CVS did say that pharmacies pay more for their services than their own retail drugstore. So there is that argument. I mean, I don't know how it turns out in practice, but there is that. I mean, of course, they will defend their own stance. And there is reason. I mean, they were able to merge for a reason.
Yeah.
And we know this administration has been tougher on clamping down.
Yeah.
Not even the administration, though, bipartisan. So.
Yeah. And we should point out there have been a couple of sell-side notes out already, including over at Raymond James, basically saying this is kind of DOA, this bill, when it finally makes it down.
Which is so interesting, though, the stocks are moving on it, though.
Yeah.
So clearly we're going to have this political headline risk. Like we've seen this playbook before.
Yep.
All right, Isabel, thanks a lot. Really appreciate it. Isabel Lee joining us from Bloomberg. I think we're going to make it, Romaine. We're looking at the NASDAQ is at a record high, up almost 2%.
It's holding that record high. The NASDAQ, of course, actually now moving to a session high is interesting, too. And the S&P, don't forget about the little old S&P.
Oh, that guy?
Yeah, that's setting up for a 58th record high as well, Alex Steele.
You stole my headline. What? Well, we're 15 minutes to the close. We're going to take it down with you with Ellen Hazen, Chief Market Strategist and Portfolio Manager at FL Putnam. This is Bloomberg.
This allocation, especially to U.S. equities, even away from other corners of DM and EM, but an increasing allocation to U.S. equities. We think that makes sense, especially over the next 12 months or so, with that U.S. exceptionalism trade just beginning to play out.
Gargi Chaudhuri over at BlackRock, kicking us off to the close just about 50 minutes ago here with stocks near session highs. I don't know what to make of the price action, though. I mean, I was looking at the S&P. It's up almost 1% to another record high, but half the stocks in that index are in the red.
So what if we just de-risked on Monday? We're neutral yesterday into CPI. Then was a benign CPI, now we're just buying back that risk.
Okay.
Like, is that a scenario which means that you don't really take any of this price action seriously? We're just repositioning now.
I haven't taken it seriously for a while because I do think a lot of this is just kind of a rotation within a rotation within a rotation. And it's sort of like, those little Russian nesting dolls. And at the end result is nothing has really changed.
Right. So then to that point, if we do see, say, mid caps and small caps rally, which we do, but we're nowhere near records for them, do they continue and then we get that rotation, or is it still going to be the record in big tech driven by stocks like Tesla, for example?
I mean, the hope seems to be that broadening was real, and we're seeing some evidence that it might be. But when you think about all the folks we talked to on this program and their outlooks for 2025, how many of them are talking about small caps, mid caps, and then whatever tech is going to do?
Yeah, well, it's always like own tech, and also do these other things. But you still can't part with tech. That's how it feels.
Yeah. It's like, I want to break up with you. I can't.
It's like the bad boyfriend.
Exactly. All right, let's bring in someone we like. Always nice to us, Ellen Hazen, Chief Market Strategist and Portfolio Manager with FL Putnam, helping us count down to the closing bells. Just about 8 minutes to go, Ellen. And of course, this is a day where we are talking a lot about big tech. They're doing the heavy lifting today. They've been doing it now really all year long, despite this hope that we should see leadership from someone other than some of those big cap tech names. But can we live with this, or can you live with this for now?
Hi, Romaine and Alex. Great to see you guys again. We think that the big cap tech stocks may be in for a resurgence next year in 2025. They are showing good earnings growth going into next year. And in general, we still prefer large cap, whether it's the big cap tech stocks or other general large cap, over small and mid. And if you look at the earnings numbers, small and mid-cap earnings just keep going down. And we can talk about that a little bit more in a second. But to answer your question, we think that it does make sense to own the big tech. And a lot of those names that had been weak technically for a while, like Tesla or Apple, are really starting to come back technically as well.
I am curious, when you look at the appreciation in price on those big tech names, I mean, there are some that are obvious why. I mean, you see the cash generation, you see the profitability, but there are a few other names in there where this does seem like mostly multiple expansion. And I'm wondering maybe if you can kind of square the circle as to what people are buying, or more importantly, what they're chasing after.
Well, it is window dressing time, right? We're 2 weeks into December. We have a couple more weeks before the end of the year. And anyone who didn't own the names that have been up a lot this year is almost certainly chasing them. So I wouldn't overinterpret what we're seeing right now. I think, though, that as we look into next year, multiple expansion is going to be hard to come by. If you look just at the S&P, it expanded by several points this year, multiple-wise, as did some of those tech stocks. And so I don't think that expecting or hoping for more multiple expansion is the way to go. I think you need to look at where the earnings growth is going to be.
Okay, so where is it going to be?
It's going to be in large cap, it's going to be in tech, but it's also going to be in consumer discretionary. It's also going to be in industrials. If you look at earnings estimates, that's where you're seeing the increases right now. And if you look at small cap, earnings estimates are still declining there. As much as we recognize the valuation differential in small cap between the index and the S&P 500 large cap index, the earnings estimates just keep going down. Whereas for the S&P, they're flat to up. So I think it's really hard to justify going into small cap. But we do think that you can buy some large cap stocks that are going to have earnings growth. And as we look at the specific names that we're buying, they're all really high quality growth names that are trading at fair prices. They're not super cheap, but they are at fair prices.
So I love that you brought up consumer discretionary because that sector has been on a tear. I mean, it's like record after record, in part driven by Walmart. I mean, Walmart's been on the 52-week high list for weeks at this point. I mean, is that the kind of sector you want to be exposed? Where in that sector is the best way to be exposed?
I think that Walmart is a great company. The stock is at least a standard deviation, if not two, above its long-term median in terms of PE. So I'm not sure I would chase it here, but they have a rock solid business model. And to the extent that the consumer is getting more squeezed, which I think is true, then companies like Walmart will benefit from that. So I do think that's a decent place to be. I also think you need to be in Amazon in consumer discretionary, of course. And I think a name like TJX, right, where you're looking at discount and moving inventory, that is going to be helpful as well as we look into next year.
I am curious, Ellen. I want you to give me a reason why I should move out of cash. I mean, if you're earning 4 to 5% and, you know, on a risk-adjusted basis, that's pretty good. I mean, it's not the 20, 30% you're getting in the equity market. But what's the reason to move out of that or to allocate less to it?
I would think of cash as much more of a substitute for fixed income than for equities. And if you look at fixed income, it's yielding about the same as cash. And I think that cash versus fixed income is kind of a wash. But the thing that you get with equities, Romaine, in addition to the growth, which we all know is there, is you get protection against inflation. And I think a lot of people have talked about how some of the incoming administration's policies are likely to be inflationary. And with cash, you're just not going to get that inflation protection. You can get it in some areas of fixed income, like with TIPS, but that's where you really go to equities or alternatively real assets.
So when we talk about balancing out a portfolio and, you know, we talk about the traditional breakdown between stocks and bonds and whatever small allocation you have to cash, Ellen, do you make room in there for more hard assets or make room in there for alternative assets or even speculative assets like crypto?
I think it does make sense to look for alternative assets that are going to be A, uncorrelated, B, possibly higher return, although some of that is a liquidity premium, so you need to be aware of your liquidity, and then C, potentially going to do better in an inflation world. And certainly real assets, whether it's infrastructure, whether it's other types of real assets like real estate, those are going to do better in an inflationary world. So I do think there's a place for alternative assets, but I would take that money from fixed income rather than from equities.
Ellen, always great to talk to you. Ellen Hazen, Chief Market Strategist and Portfolio Manager with FL Putnam. We're counting down to those closing bells, Alex, just about 3 minutes to go here. And we talk about animal spirits. I mean, the NASDAQ, of course, setting up for a very significant record high, not just because the index is at a record high, but you look at some of the names. Like, I mean, I kind of forgot that Tesla hadn't had a record high since 2021 and now hitting that. So Broadcom, Tesla, NVIDIA, Alphabet, Amazon, Meta, Microsoft, all leading the charge.
Yep, and you have $515 billion in the last 6 days when it comes to Tesla. So it was actually quite impressive. But again, it's not just that. I go back to Walmart, also hitting 52-week high after 52-week high. Maybe not today, but still, that's also been weirdly impressive.
Do you know we actually had a SPAC deal today? SPACs are back.
What? We had a SPAC deal?
Crypto,
really?
Yes. Yeah, crypto is back too.
Deal?
A crypto SPAC deal.
Oh
doesn't get any more speculative than that. A full breakdown of all of the market action starts right now.
The closing bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell. A global simulcast. It starts right now. We're joined right now by Scarlett Fu here in the TV studio, a waving Carol Massar in her radio cage. Tim Stenovic by her side as we welcome all of our audiences across all of our platforms here on an incredible day. And I say incredible, Carol.
Did you say radio cage?
Did you say radio that kind of went over your head real quick there. Relax, Carol. We're getting there. It's a beautiful cage, but we talk about the gilded cage. We talk about these animal spirits in this market, Carol Massar.
Yes.
A record high for the S&P. It looks like that's going to happen. A record high for the Nasdaq, but more importantly, some individual record highs on names like Meta, like Tesla. Names that really haven't been, and Google for that matter, Alphabet, that really haven't been at the top of the leaderboard for a while.
Yeah, pretty impressive. And I think it's, I don't know, we've been talking a lot about it in our, what did you call it? Radio cage.
Mm-hmm.
But just, you know how it gets to a point where the valuations people get, market folks, and say, okay, it's time, like broaden out, go to other names. And then all of a sudden these guys come roaring back and investors seem to be buying into them again. So I don't know. I always am very suspicious of when people are like the big tech rally over.
Look at just the names at the top of the NASDAQ 100 right now. They're driving it higher. You got Broadcom, you got Tesla, you got NVIDIA, Alphabet, Amazon, Meta, Microsoft, Netflix. I mean, all above, all up more than 2%.
I'm just looking at what the Magnificent Seven has done so far this month, up 11% for the month. That's compared with the Russell down about 1.5%, and the S&P 500 pretty much going nowhere, up less than 1%.
All right, well, we get the closing bells here in New York, and it is a good day for at least the S&P and the NASDAQ as the clapping starts here. And you take a look at who's ringing the bell. We're going to talk a little bit about that in a second here with the Dow Jones Industrial Average sitting this one out, down almost 100 points or 0.2%. The S&P 500 looks like it's going to close right around 6,084, so up roughly 49 points or 0.8%. The NASDAQ above 20,000, higher by about 347 points on the day or 1.8%. The NASDAQ 100 up 1.85% to be precise. And the Russell 2000 participating in today's rally, a gain of about 11 points or 0.5%.
All right, what's interesting is to see these moves up. And if you take a look at the S&P 500, guys, almost an even split in terms of ups and downs, in terms of gainers and decliners. 236 names, Scarlett, to the upside in the S&P 500, 264 to the downside.
All right, let's take a look at the sector performances here, because you'll see some lopsided moves, especially when it comes to those big tech sectors. Communication services, consumer discretionary, each up at least 2%. In the case of communication services, up 3%. And tech as a group up 1.5%. That's largely on Broadcom. On the downside, healthcare losing 1.3%. Consumer staples and utilities also down by about 0.5%.
All right, let me get to some of the individual gainers. Got to do Broadcom. This is your top gainer in the S&P 500, top gainer in the NASDAQ 100, up about 6.6%. We know it. We probably all talked about it throughout the day. Apple is developing a server chip designed especially for AI, working with Broadcom on the chip's networking technology. This is from The Information, citing a person with direct knowledge
I'm so
of the
confused
project.
by this relationship between Apple and Broadcom. I don't know, because first it was like they were breaking up with Broadcom and Broadcom was falling. Then it was like, no, actually they're embracing Broadcom. What's going on?
Qualcomm's the
Qualcomm.
boyfriend that is getting tossed.
Well, I know. Well, no, Qualcomm. But I'm talking about Broadcom. The other com.
Yeah, the other com. No, but they also extended a deal that they had for the next few years, too. So it's like they're picking and choosing which one of the chip guys they're going to stay with.
You know this tech community, man, frenemies, right? They work together, they hate each other, they work together.
Keeping them on their toes, basically, right?
How many comms are there?
If there's money to be made, they figure out how to work together. That's all I'm going to say. All right, so that one's certainly a standout. Alphabet, it was a top gainer yesterday in the major indices. And again, we're seeing it among the biggest gainers, up about 5.5% in today's session, hitting its highest intraday ever, building on yesterday's gain of about 5.6%. That was the biggest one-day gain since April. It has gained about 12% over the past 4 trading days. That, you guys, would represent its biggest 4-day advance since November of 2022. You know, a lot of it is over the excitement over a major development in quantum computing through the use of its Willow quantum chip. I feel like AI has been a lot of what we've talked about the last year and a half, 2 years. I feel like quantum is going to be a lot of what we talk. Tesla had to name that one, hitting its first intraday record record since 2021, again, driven by the company's self-driving ambitions under a Trump administration. A lot of optimism over that. Also, we should point out that today we saw Elon Musk topping $400 billion in wealth, first person to ever reach that in net worth. And I also want to point out, did you know that the stock, Tesla's already up about 20% this month already after what, a 40% gain in November. So just kind of blowing it out. And this one is courtesy of Tim. Also for you, Romaine, I know you love those small caps. Candle Therapeutics up 68%.
What?
It's a clinical
Candle,
stage.
not candle.
Yeah,
Okay.
yeah, Candle. Well,
he was thinking fragrant candles.
Candle it is, yeah.
Okay.
It was up 216% at one day, triggered a circuit breaker, finished the day with a 68%.
Wonderful.
Clinical stage biopharma company,
what's the
late
market
stage
cap?
study. I know, but you talk small caps all the time. You talk about how it's so important.
It is important.
Anyway,
Had a good year, right?
Late stage study of its CAN 2409 product candidate.
Yeah.
Key goal in prostate cancer. It's an important one.
Yeah,
So
it is very important. I didn't mean to make light of it, but
I'll just stay
Good
in my
work
little
there.
cage and
That's right.
take the abuse. Go home. All right, Tim.
Okay, here we go. Look at that. I got three decliners.
I know. Well, you kept sending me names. You got to do this. You got to do this.
Follow the rules here. Uber down 5.8% today. Uber and Lyft shares both fell following GM's decision to stop funding its robotaxi development over in its cruise unit. Mandeep Singh over at Bloomberg Intelligence, he said at first glance it appears to put the capital onus on Uber to fund the program, even if it is to stay alive, which we're not sure is realistic or desired from an Uber perspective. And it raises the question of whether AV economics can actually work at all. So a lot of questions about autonomous vehicles in the wake of GM pulling the plug on this late yesterday.
Speaking of,
go ahead.
Microsoft sees about an $800 million charge in the second quarter because of its stake in GM Cruise. It just came out with their 8K.
Yeah.
They have a minority investment in Cruise. They've had that since January of 2021, and they had to sort of write that down now because of it.
Look at that. Sometimes the timing is perfect.
Perfect.
Thanks for the assist, Alex. Do
You're
appreciate
welcome.
that. Walgreens Boots Alliance shares fell today by 5.6%. It wasn't the only healthcare/pharmaceutical chain company to close lower today. CVS shares fell 6.2% to close at the lowest, going back to 2013. Walgreens Boots Alliance shares surged yesterday by as much as 28% following that report that Sycamore Partners would acquire the company. Today shares giving back some of those gains. Romaine, I know you got your eye on some earnings crossing.
Yeah, earnings season, of course, never stops. Adobe out with its most recent report here in the fourth quarter, adjusted EPS of about $4.81. That's a beat. The street was looking for $4.67. Revenue up about 11% in the quarter, $5.61 billion. That's also a beat as well. And subscription revenue up about 13%. We should point out product revenue, of course, a business they've kind of been shunning to a certain extent. That was down by about 30%, but that's one of the smaller parts of their business. Their full year 2025 full year forecast, they see adjusted EPS in the range of $20.20 a share to $20.50 a share. That's pretty much right around what the street was looking for. The average estimate was $20.52.
All right, we'll dig into that a little bit further, but we also have earnings crossing from a retailer, Oxford Industries, Lilly Pulitzer, Tommy Bahamas. Yes, thank you, Kay. Thank you, Finley, for giving me that heads up on it. Oxford Industries coming out with net sales for the quarter, fourth quarter net sales of $375 to $395 million. Analysts were looking for $389.2 million. Fourth quarter adjusted EPS, this is the outlook, of $1.18 to $1.38. That is much lower than the anticipated estimate of $1.55. Full year net sales anywhere from $1.5 to $1.52 billion. That is somewhat lower than its previous range of up to $1.54 billion. And for the quarter that did end, it reported a loss of 11 cents that was wider than the anticipated earnings per share gain of 9.3 cents. I'm not sure that we're comparing like with like there. Nevertheless, stock just marginally higher right now. All
right, we're also taking a look at Jay Jill here. The CEO, Claire Spotford, is going to retire in April. We're getting that headline. The third quarter earnings, though, coming in stronger than estimated, coming in about 89 cents a share. Going back to Adobe, guys, real quick, that digital media segment, if you take a look at its net new annualized recurring revenue, seemed to beat estimates, coming in at $578 million. It beat estimates, but that stock is still down just a bit.
Yeah, shares. Go ahead, Mermaid.
Well, it's kind of interesting, too, because even when you look at some of the other forecasts they're giving, I'm trying to kind of make sense of why we're seeing the drop in the share price here. It does look like when you talk about a forecast, is not really a forecast for a tremendous amount of growth. I mean, basically the numbers they're giving on the revenue side and on the bottom line are just maybe a tight, just a little bit of a slightly below the average of street estimates. But again, I think it's a representative of that year-over-year growth not being as strong as what investors have gotten used to.
Yeah, I think it's that 2025 year forecast. It sees adjusted earnings per share $20.20 to $20.50. That estimate was for $20.52, so coming up just shy there. And then that first quarter forecast, $4.95 to $5 for EPS. Estimate was for $4.95. So maybe that's what it is.
Yeah, just maybe looking for a little bit more. The CFO also some commentary. We expect an approximate $200 million headwind to fiscal year 2025 revenue as a result of the effect of foreign exchange and a smaller impact of the continued move to subscriptions from perpetual offerings. So again, a little context around that
perpetual.
report.
You guys saw
like
this
ownership?
Sora. Did you see that OpenAI Sora was released this week?
Question.
The video generation tool?
Yes, we did.
I wonder if there's going to be some questions from analysts about how that competes with Firefly and all the image generation that we're seeing from startups getting on Adobe's turf.
There's so much competition in this space.
I guess Adobe would say, this is what we have is copyright safe, so if you use it, you won't get in trouble. There's some, it's understanding how it's trained, I think, is becoming a big part of the conversation.
All right, we got to go back to our cage. So really fun. Really appreciated that. This was fun. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do it across the Bloomberg world. We will see you again, same time, same place tomorrow for the closing bell.
We continue our coverage here on Bloomberg Television as we try to parse these earnings that we just got out of Adobe. A lot of questions right now about why we're seeing such a significant drop in the shares in the after-hour trade. We're going to try to answer those questions when we come back with Gil Luria over at D.A. Davidson. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day on Wall Street today. We had the S&P at 1 point trading at a record high. Now, it closed just a few points shy of that. But there was a lot of euphoria in this market, and you see that reflected in the NASDAQ 100. Up about 1.8%, 21,763 and change. That is a record high. And more importantly, some of the individual names in there really setting some impressive record highs, including Alphabet, the first record high for that stock in a few months, and Tesla, its first record high since 2021. You see the juxtaposition with the Dow Jones and transportation average here. In fact, one of the biggest underperformances we've seen of that average relative to the broader market in quite some time. Your 2 years still camped out around 4.2 and change. And look at this, an interesting rally in Bitcoin, up back above that $100,000 mark, Scarlett. Animal spirits are out, and I'm told SPACs are back, and more importantly, crypto SPACs are back.
Absolutely, and combine it with crypto, and you get a coin check, which is up, but not by 27,000%. That's a misprint there, so my fault, typo there. But CoinCheck going public today as a listed company after its merger with the SPAC Thunderbridge Capital. So first day of trading for that company, which is a unit of Monex in Japan. United Health, a big decliner here, worst performer in the Dow Industrials, losing more than 5.5%. The U.S. healthcare companies that own pharmacy benefit managers, we're talking about United Health, CVS, Cigna, they're all under pressure today as a bipartisan group of lawmakers led by Elizabeth Warren and Josh Hawley drafted legislation that would force these companies to sell their PBMs. Now, it's not clear that this is going to get done during this congressional session, but certainly it kind of sets the tone for the new year. And Broadcom, we're going to talk about this more in a moment here, but this stock up by 6.6%. The best performer in the NASDAQ 100. Apple working on an AI chip with Broadcom, according to the information publication. This chip is expected to be ready for mass production in 2026. Romaine?
All right, well, the software company Adobe out with its earnings. The shares moving a little bit lower here in the after-hours trade for the most recent quarter here. It did beat on several key metrics, including $5.61 billion in revenue and $4.81 in adjusted EPS. But the guidance going forward may be giving investors a little bit of pause here. Revenue for the full year in 2025, $23 billion to roughly $23.5 billion. That's just a tad below what the street was looking for on the low end of that range. But let's get some insights out of someone who knows this company better than us, and that is Gil Luria. He's managing director and head of technology research at D.A. Davidson. And I want to start off with the forecast because that seems to be what the knee-jerk reaction in the markets is about. But these aren't like huge misses on this forecast. I mean, we're talking about, really the difference of a few bucks here or there. What was your take out of what we learned out of this press release?
This is a good result and good guidance. I agree with your characterization that there's a knee-jerk reaction here for fiscal 25 guidance. This is really just an accident of calendar. Adobe's fiscal year ends before December, so they're guiding for next fiscal year before other software companies. Most software companies, if not all software companies, are going to still have to guide conservatively into next year because there's still a lot of uncertainty. Even though most software stocks have done well because we expect next year to be a better spend environment, that doesn't mean these companies are going to be aggressive in their guidance for next year. Adobe just happens to be guiding first for next year. That guidance is still good. It's for double-digit growth. It's for better than double-digit growth on earnings. It's just slightly below consensus, which to your point is leading to a knee-jerk reaction right now.
Of course, all the talk right now is about AI and whether how it's going to be accretive to the company's growth and to its bottom line. As we were speaking, Gil, a new headline coming out of that release, and that is Adobe is going to introduce a new higher price offering of its Firefly AI technology. And I guess it raises the question as to how much adoption have you seen of Firefly? I know it's being folded into Photoshop, Illustrator, and some of the other programs, but how much adoption have we seen, and how much pricing power do you think Adobe actually has on it?
So two different answers to that. So in terms of adoption, the adoption is amazing. They're able to get that product into many of their users' hands, millions of users, billions of uses of Firefly, but they are justifiably hesitant on trying to monetize too early. There's a lot of free offers out there for automatic image generation and short video generation. You don't want to start charging for your product when there's products in the market that are free. You want to make sure you get that usage, you get it habituated, you get it within the Adobe workflow. The monetization will come later. These are very helpful tools that are making their users more productive, and they will be able to monetize it. It doesn't make sense for them to over monetize in the short term.
Okay, so what you're saying is there's a sequence to how this happens, Gil. And I'm wondering, is it possible for a company like Adobe or anyone who's doing this really to be able to focus on making sure customers engage with these new AI products and directly make money from it at the same time? Does it have to be an either or? Can it be a both?
I think that's what they're going for. They're trying to thread that needle by driving more usage of all their other products that incorporate generative AI, getting new users, expanded users, getting users to use the product more because they can be more productive, getting them to use higher tier products. That's a way to drive growth in the short term before you start charging too much for each image generation. That will come later because it is expensive to generate these images. At a later point in time, when their product's established, they'll be able to charge directly for image generation. Right now, it makes sense for them to continue to thread the needle and just sell more of their existing products.
Is there anyone in a position to be able to charge more right now?
Not at all. Not at all. In fact, all the other image generators are free and are really just burning through VC money as they do that because there's not much you can do with just generating an image. An image isn't worth anything if it's not part of a campaign that you can edit, put through workflow, get to your agency, get it out to consumers. That's the value added for Adobe. All these new upstart image generators are just incinerating money because that inference is very expensive. If they're giving the product away for free, they're just capturing users that are turning around and putting it into Adobe in order to have a campaign and an image that they can send out to customers. That's not sustainable. And there really isn't anybody else that can do this and monetize it at any point right now.
Got it. Gil, thank you. Needed to hear that. Patience is warranted here when we're talking about these software companies and how they monetize their AI products. Gil Luria is Managing Director and Head of Technology Research at D.A. Davidson. And as we were just mentioning earlier, Apple reportedly working with Broadcom on a server chip that is specifically designed for AI. For more on this potential tie-up and a broader look at the semiconductor sector overall, let's bring in Bloomberg News reporter Ian King in San Francisco with his decades of experience covering the chip sector. Ian, let's just take a step back here for a moment and talk about the relationships that form here between a company like Apple and its suppliers like Broadcom, and now its potential partner in forming its own hardware. It feels like there's a frenemy kind of relationship, as Carol Massar was talking about here. I'm not sure if they're friends or they're foes or they're competitors or they work together. It's a little bit of everything, and I'm not quite sure how to read this idea that they're working together.
Yeah, I mean, there's a whole kind of swirling mass of competition and cooperation. As we know, Apple is one of the biggest buyers of silicon, but it's also arguably the leader in terms of large companies that are now designing their own parts. Broadcom kind of half fits in and half fits out of that. It supplies Apple with modems for the phones, and it's also a key supplier of what are called ASICs, these specifically designed chips. It does for people like Google, and that's the kind of data center AI play. So they're a logical step if Apple is seeking to carve out independence and seeking to avoid having to go and pay NVIDIA like everybody else does.
That raises the question, though, and I know we probably don't know all the inner workings of how this deal came to be here, but do you think Apple truly has, I guess, more of the advantage in this relationship with Broadcom than they would have with NVIDIA?
Well, I mean, that's a very good question, and all we have is speculation over the years, but it's absolutely true that Apple has not been a user of NVIDIA silicon over the years. It's offered AMD and graphics chips from them. And that's always been analyzed as being something where Apple says, hey, we've got the brand, we've got the volume, you need us, this is what you're going to pay. Whereas NVIDIA has a very strong brand of its own in graphics, and now obviously in AI, says we don't need your orders. So there's always been that tension between them, according to what we understand.
Ian, very quickly here, Broadcom will be reporting earnings tomorrow. We were talking with Gil Luria earlier about how software companies really need to wait before they can monetize on their AI products. What does Broadcom's AI chip sales look like in terms of demand?
Yeah, I mean, that's a very good question. They have it's a small business for them, relatively small business for them. They've got all kinds of businesses in the chip industry and software. Those kind of AI businesses in the chip industry aren't that great right now, but we've been told they're bottoming out. But as you pointed out, everybody will be focused on that relatively small but really fast growing segment, which is AI.
All right, Ian King, always great to talk to you. Ian King, of course, Bloomberg's semiconductor Swami there, talking everything chips for us and that relationship between Apple and Broadcom as it moves forward in that competition for proprietary chips. All right, when we come back, we're going to talk about our top three, the big people, three people that we're keeping an eye on here, and that includes a look back at the career of Sallie Krawcheck and, of course, the life and legacy of David Bonderman. Don't miss that. It's coming up next right here on The Close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Sallie Krawcheck, the pioneering Wall Street veteran who co-founded Ellevest, a wealth management firm with portfolios geared toward women. She is stepping down as CEO. She cited health reasons, but she will remain on the board and provide guidance. And of course, Sallie Krawcheck rose to prominence as a star bank analyst at Sanford C. Bernstein. She later led the firm. She became CFO of Citi. So she's had this long, storied career on Wall Street.
Yeah, I mean, of course, brought in to sort of run that Smith Barney unit and really made a name for herself. Kind of interesting. Obviously, she's not discussing specifically what her healthcare diagnosis is, but we should point out she's still relatively young, 60 years old. So maybe she can work through this, and maybe we'll see her back in the office sometime.
We would love to see that, Sallie.
We're also keeping an eye on Andrew Ferguson. He is going to be, pending confirmation, your new chair of the Federal Trade Commission. And it's an interesting pick. He's already on the Federal Trade Commission as a commissioner. He's going to replace Lena Khan as a head of that. And it's kind of interesting because he's sort of broken ranks with Lena Khan on a lot of the sort of stringent sort of tactics that she's taken over the last 4 years. But also interesting that when Trump sort of tweeted out on Truth Social, there's a point where he talked about how he's going to rein in big tech and fight for free speech. So I'm not sure what to expect out of him, but Wall Street seems to like that name.
There's some continuity there, so it doesn't upset too many apple carts. But at the same time, like you said, he's really gone head to head with Lena Khan over the ban on non-compete clauses and employment contracts, as well as rules to make it easier to cancel subscriptions, which I find kind of curious. That's like firmly more populist take. But it's interesting. I guess it was inevitable, even though for a while there's some speculation that, because J.D. Vance praised Lena Khan, that maybe the Trump team would keep her on.
Yeah.
Not so much.
Yep.
All right. Well, speaking of deal making, we also want to take a moment to remember David Bonderman, co-founder of private equity firm TPG. He has died at the age of 82. Of course, David Bonderman was a leading member of a generation of financial entrepreneurs, tycoons who built fledgling buyout shops into Wall Street powerhouses like Henry Kravis, like Steve Schwarzman. He drew skepticism with his first big deal in 1993. He led the almost $500 million recapitalization of Continental Airlines during its second bankruptcy, made a lot of money off of that.
Yeah, I mean, he really was a pioneer in this space, and you talk about how far-reaching it was. Obviously, he had a big presence in the world of sports, big presence in Hollywood, too. I kind of forgot, I was reading his obituary, I kind of forgot about that whole tie-up with the CAA for all those years, which, of course, they divested, I think, in 2023. He was an early investor in Spotify and Fandom, so a lot of stuff in the entertainment space as well. Of course, an LA native, and not only going to be missed on Wall Street, but out there as well. David Bonderman, gone at 82.
We've put in place tariffs now. They're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports.
The former Fed chair and current U.S. Treasury Secretary Janet Yellen, in an exclusive interview earlier today with our very own David Gura, discussing a wide range of issues, including tariffs on China and why broad-based tariffs would harm U.S. competitiveness. Of course, Yellen says as Treasury Secretary will likely come to an end in just a little over a month as the new administration takes over for the Biden administration. Scott Bessent, of course, President-elect Trump's pick to head that department. Jennifer Flitton joining us right now. She's head of U.S. government affairs over at Invesco. And Jennifer, I do want to talk about the potential contrast between a Treasury under Janet Yellen and a Treasury under what we presume is going to be Scott Bessent, assuming that he does get confirmed by Congress. Do you think it's going to be materially different in their approaches?
Yeah, I do, actually. I think because it really comes from the top down. So with President-elect Trump coming into office, he's going to have an agenda that is very, very different from the current president. And of course, the Treasury Secretary has a lot of jurisdiction here, and a lot of it is international in nature. And so he will be driving the Trump message. But he's just one of many economic advisors at Trump's table. You have Kevin Hassett, who's going to be the NEC head. You have USTR with Jamieson Greer. You're going to have Howard Lutnick over at Commerce. You have a real sort of diverse thinking at this table, somewhat similar to the first Trump term.
Well, I am curious whether this economic team writ large is going to potentially be in conflict. And I don't mean that on a personal level, but I mean when it comes to some of the policies that the president-elect made on the campaign trail, there are a lot of those policies that potentially, at least economically speaking, are going to be in conflict with each other. And it's people like Scott Bessent and Kevin Hassett and all those other folks you named, they're going to have to try to sort this out and convince the president of the right thing to do.
Yeah, that's right. I mean, I think this is going to be incredibly dynamic, and it's going to be a very live exercise, especially at that table. But, as we're approaching January 20th, Inauguration Day, we know it has been reported that there are over 300 executive orders that have currently been crafted. As the president-elect rolls out his initial priorities via executive order in that first 24 hours, I think we're really going to be drinking from the fire hose. That first week is going to be rather intense. And I think it is going to be focused on trade and tariffs, on energy production, and, immigration and innovation. So I think there's going to be a lot of economic discussion in those first several days.
Okay, or over 300 executive orders. That's a lot to kind of get your head around, Jennifer. I'm still struggling to kind of figure out how many that leaves us per day of the week. What is your understanding on what will be tackled on day one for investors to really focus on?
Yeah, I think he's going to focus on energy. I think he's going to focus on immigration and some sort of trade announcement in that first 24 hours, that first week of his new administration. And then you're going to have a number of discussions on the Hill as to how to roll out reconciliation. And there's a difference of opinion right now on the Senate side and the House, right? Because you have Majority Leader Thune, who wants to focus on the military, energy, immigration, that first reconciliation, and then do tax reform later. You have Jason Smith, the chairman of the Ways and Means Committee in the House, who has been very vocal about wanting a sort of all-inclusive reconciliation, because remember that the House is only a majority by one vote. So that means, all these Republicans are going to be sort of like junior senators sitting there with a lot of power. Yeah. So it's going to be tough.
I want to go back to something you said about the trade announcements, how that's probably going to be a priority. I get that. But we also know, or a lot of people say, that the tariffs threats that he's issued so far are the start of a negotiation, right? It's something that we're not going to end at 25% for Canada and Mexico, or an additional 10% for China. That's kind of the starting point. Does he do that through an executive order anyway? And then you can always change the executive order as the final numbers come through? Or is that something that will be negotiated in the meantime to the run-up to January 20th?
Yeah, I think that's the open question, right? Does he use emergency powers, which is something he didn't activate in his first term? Does he do that in the beginning days of his administration to sort of kickstart those conversations with Mexico, Canada, and then separately with China? That USMCA, the U.S. Mexico-Canada agreement, is coming up in 2026. Having the best leveraging position is what is most important to this new administration coming in. And some of that's going to have to do with big, aggressive announcements.
I am curious here, Jennifer. We talk about what the president can do through executive orders. And I'm just going to take a guess and say that there are going to be several executive orders that come out in that first day or first week that probably shouldn't have been executive orders. How much support is he going to have from a Republican Congress, particularly when we know that there are a few Republican centrists that at least publicly have said they plan to push back on some of the policies that Trump is proposing?
Well, I think there's a number of things that he can do on the executive side. And a lot of that in the beginning days is going to be overturning the previous administration's regulation and rules and guidance that they did at their own discretion. That's just sort of expected. But then you also have, to your point, legislatively, right now in the House and in the Senate, all of the committees of jurisdiction are working on their Congressional Review Act priorities. And that means that they'll have the opportunity, because there is this Republican trifecta in Washington, to overturn regulation that was done through this administration pretty much at late August. Any rules or regulations that were passed after that, they'll have the opportunity as well to overturn those regulations. And so I see the House and Senate, especially with the majority leadership in both the House and Senate, working very closely with the White House on this. And I think really being steered through the Office of Management and Budget.
It's steered through the Office of Management and Budget. And when we talk about the pace of which things are progressing, and at least based on what we know publicly in terms of them basically preparing a lot of things in advance, something they didn't do in 2016, with the idea that they could come out of the gate on January 20th running, how much of a runway, or excuse me, let me rephrase that, how much of a honeymoon do you think they're going to have? I mean, most presidents usually get, whether it's the proverbial 100 days or whatever, to kind of do what they want without too much pushback. And then eventually we know that pushback comes.
Yeah, I think there is an understanding, and in my discussions with senior leadership in the House and Senate, it is going to be all hands on deck. There is definitely a sense of mission here. I think it was reported earlier this week that President-elect Trump called into the Senate conference meeting and vouched his support for John Thune and sticking behind John Thune. I mean, I think he's going to be relying on the majority leadership in the Senate and with Johnson as Speaker in the House to really drive through this agenda. And they're working in pretty close concert right now. I will say, that sort of division right now on reconciliation and how to get things kickstarted, because you have to do that in a budget resolution. You have to include those reconciliation instructions, and they're going to want to do that in the first 2 weeks of the new organization of Congress next week. Those sorts of discussions are really like a House-Senate discussion and breaking through on coming to common ground on how to move forward on that reconciliation.
All right, Jennifer, you've given us a lot to think about. Jennifer Flitton is head of U.S. Government Affairs at Invesco. Thank you so much. What's interesting about this new look Washington that we're going to get in 2025 is how the House committee leadership is going to be changed completely. It's going to be all men for the first time in almost a decade. There are no women who are going to be holding the gavel in the House.
Yeah, that's interesting. This caught my eye when we talk about whether it was deliberate or whether we just didn't have enough competition for some of these seats here. But a lot of people are, of course, making a big to-do about this and why they didn't at least select, a couple of folks out there who were running. We should also point out, too, I was looking at the numbers themselves. I mean, the number of women is going down in terms of representatives. I mean, I think it was prior to the November election was like 127, which is only like 30% of the House of Representatives. That's going to be a lot lower once the new Congress is sworn in January.
Yeah, but, a lot of women will be looking at this and saying that, this kind of dovetails with the criticism from the Republicans on DEI initiatives as well. So, you kind of have to square that. In any case, let's take a look at how markets closed on the day. We had the S&P 500 gaining 0.8%. We didn't get to a record high, did we?
No, we just came, looks like about 6 points or so short of it on the S&P 500. But look, you can't sneeze at that, Scarlett. I mean, if you had started this year and say we were going to be above 6,000, there were only like a couple of people who said that, and we thought they were crazy back in January.
And now people are talking about 7,000, right?
Yeah.
Okay, so the Mag 7 continues to power ahead. They've been on a tear since the start of this month. That group up 3.1% on the day. The CPI report that everyone waited for didn't do much for bond yields at all. The 2-year staying at around 4.15%. We should mention that the loonie did get a boost after the Bank of Canada indicated it will move gradually with further rate cuts.
All right, a big rate decision tomorrow out of the ECB, and of course another one next week by the FOMC, and that will pretty much wrap up the year for the major catalysts here in financial markets. When we come back after the break here on The Close, we're going to take a look back in history at the arrest of Bernie Madoff, and we're going to talk about the largest known Ponzi scheme in history. That's coming up next right here on Bloomberg. All right, time for a look back at this day in history. December 11th, 2008. Bernard Lawrence Madoff, the investment advisor who promised stellar returns, to A-list clients, all while defrauding them of more than $19 billion, was arrested and charged with running history's largest ever Ponzi scheme. Pulled out of his Manhattan apartment building in the morning hours, the arrest would officially unravel a multi-year scheme where Madoff used money from new investors to repay older investors. In some cases, creating false trading records to cover up losses and non-existent investments. Now, much of the government's case was actually based on Madoff's own words to colleagues and family members about those business practices. So much so that Madoff, just 3 months after his arrest, he pled guilty to fraud, money laundering, perjury, and theft. In court and later in interviews from prison, Madoff insisted that he actually ran a genuine investment business for years before finding himself unable to maintain the returns his clients had come to expect, and that, he said, is when the fraud started. Now, it's impossible to verify that claim, but we do know that Madoff did indeed oversee a legitimate market-making and prop trading business out in the open on the 18th and 19th floors of that red cylindrical lipstick building in Midtown Manhattan. But it was on Madoff's private 17th floor office, off limits to most employees, where prosecutors said most of the fraud took place. Madoff's big-name investors included folks like then New York Mets owner Fred Wilpon, actor Kevin Bacon, and even activist Elie Wiesel. But unlike Charles Ponzi, a seemly character whose 1920 con made his already tarnished name synonymous with investment fraud, Madoff for decades held a level of esteem on Wall Street that really belied what he was doing behind the scenes. His early business ventures back in the 1960s and 70s, that actually led to the push to take the over-the-counter pink sheet stock market and computerize the dissemination of quotes. It was technology he effectively invented that became the foundation for the creation of the NASDAQ in 1971. In fact, Madoff served as chairman of the NASDAQ in the early 1990s. And his fraud, quite frankly, it might have continued on if not for plunging equity markets amid the crisis in 2008 that prompted his clients to seek more withdrawals than Madoff had the cash to accommodate, almost to the point that even the deftest sleight of hand would have had little impact at all. In July 2009, Madoff was sentenced to serve 150 years in federal prison in North Carolina, where he died about 12 years later at the age of 82.
I think about the actors who have played Bernie Madoff, and I almost see their faces more than I see Bernie Madoff now, whether it's Richard Dreyfuss or Robert De Niro. I think in the Robert De Niro HBO movie, it was Michelle Pfeiffer who played Ruth Madoff. So it's really loomed large in popular culture. All right, let's switch gears here now and turn to the global economy. We had a CPI report out this morning in the U.S., and tomorrow morning we'll get the ECB's rate decision. So joining us now with her outlook on the global economy and global markets is Sharmila Whelan. She is global macro strategist at Westbourne Research, and she joins us from London. Sharmila, it is great to see you. The ECB is set to make its last rate decision of the year. That comes about a week before the Fed does the same. Both are expected to cut rates by 25 basis points, but that's kind of where the commonalities end, because beyond that, they're really on very different paths. U.S. economic growth is solid. Europe's is fairly tepid. Does the ECB need to be more aggressive, go beyond 25 basis points?
It probably needs to go beyond 25 basis points, but I think it'll deliver 25 next week, simply because inflation has ticked up in the euro area. It's increased from 2.7 to about 3% in November. But having said that, they're going to continue to cut steadily as growth concerns and concerns around political turmoil in Europe takes the front seat and concerns around inflation the back seat.
Yeah, and I'm glad you bring up the political turmoil, right? Budget disputes in two of the biggest Eurozone economies have led to essentially political crises. You've got first France, and now you have Germany getting ready to hold a no confidence vote. The ECB, in contrast to the Federal Reserve, is a single mandate central bank, only focused on inflation. That's it. But I wonder, how does it fold in the political dysfunction into its calculus of risks going forward?
It's a difficult one, right? Because the ECB's mandate is price and growth stability. And as you pointed out correctly, Scarlett, first and foremost, is price stability. But as we know, in reality, the ECB is normally more willing to sacrifice, given between a trade-off between growth and inflation, go for growth. The political risk, I think they're going to be looking at what they can do to stabilize the bond markets in terms of yields, and if the political risk premium reflects in bond yields, they will respond through liquidity measures to calm the bond market.
It's kind of interesting,
but there isn't a whole heap they can do beyond that.
Yeah, Sharmila, and I mean, when we talk about all the issues that now plague the euro area, we're taking a look right now on screen at some of the GDP growth projections for the next few years, and not awful, but certainly not standing up to what we're seeing here in the United States. And I do want to get your thoughts here on the pace of monetary policy here, particularly with the big Fed meeting next week, and maybe some potential changes to what the Fed looks like in about a year and a half's time. What's your expectation?
So, Roman, as you know, the market has kind of pretty much fully priced in a 25 basis point cut next year. I'm sorry, not next year. That would be a bit too much. Next week. I'm not completely convinced that the Fed will deliver. Not so much so because of the uptick in inflation, which is, as we know, picked up to 2.7. That's the second month inflation has picked up. But the market is taking it as inflation is tame. I think my concerns are more around the equity market valuations, which are very, very stretched. And does the Fed want to fuel that further? The other thing is, I would think they would want to hold fire until after Donald Trump's inauguration on the 20th of January, when there'll be, after which there should be a bit more clarity on what's going to happen with fiscal policy and his policies in general. Well, we'll see.
But I am curious. I mean, you have a market right now that is primed for a rate cut. I mean, that's what they priced in. And if Powell comes in next Wednesday, and you see that statement, and it says we're not cutting right now, he's going to have to answer a lot of questions at that press conference, not just about when they cut, but really to explain the thought process of why they didn't move. And I am curious what that thought process would actually be. Is it just about the fact that inflation may not necessarily be tamed?
One is about inflation, not that, I'm expecting now, the inflation to have reversed trend and now it'd be on a rising trend. It's not that, but the inflationary pressures are still kind of there, but much more muted. But I think the biggest argument against cutting interest rates again next week is the resilience of the U.S. economy. And okay, sure, we've seen the unemployment number tick up in November as well as, claims. But, if you look at non-farm payrolls, they're growing at a very steady 1.4% year on year. Again, wage growth is a very solid 4%, and retail spending and real consumption is actually picking up. And given the resilience of the economy, the the Fed can afford to wait.
Very quickly, your overall take on the incoming Trump administration is that it is good for the U.S. economy, but you also see it as good for the rest of the world. Can you briefly explain why that is when, in general, Trump sees the world as a zero-sum game?
All right. So just in one line, I see Trump, as you say, good for the U.S. economy, good for the rest of the world. The biggest loser is going to be Europe. Answering your question about why is he good for the rest of the world, for a few reasons. One is the Inflation Reduction Act is dead. The Science and Chips Act is going to be diluted and amended. And let's face it, both of them are really protectionism, right, which is going to be dismantled. I expect the U.S. Corporate tax rate to come down further, and deregulation to be the cornerstone of Trump's policies in the second term, which speaks to a strong economy, strong corporate earnings growth, obviously also the stock market, and the rest of the world benefits from that. Other things, the conflict in Ukraine is over.
Sure. Hey, Sharmila,
Trump will. Sorry. So there's on a number of fronts on which Trump is. Going to be a positive.
All right, Sharmila, we got to leave it there. Sharmila Whelan, global macro strategist over at Westbourne Research. We'll be back in a moment. This is Bloomberg. Some of the potential market-moving events over the next 24 hours includes economic data in the U.S.
Yeah, we're going to get jobless claims and PPI, another read on inflation.
9:30 a.m. tomorrow, President-elect Donald Trump is scheduled to ring the bell at the
downtown.
NYSE. I was just checking, only two sitting presidents have ever even visited the New York Stock Exchange. That was Bush back in 2007 and Reagan in 1985. That does it for us here on The Close.